Welcome everyone. I'm excited to kick off this presentation hosted by Software STC Market Bowl. Today, we'll be exploring the fascinating world of market liquidity. We'll dive into the differences between buy-side and sell-side liquidity, helping you understand how these concepts impact trading and market dynamics. Over the next few slides, we'll cover key insights and practical aspects to enhance your understanding. Let's get started. Let's take a moment to understand what liquidity means in the context of the Forex market. Liquidity essentially refers to how easily you can buy or sell a currency without causing a significant impact on its price. It's about the availability of orders, both buy and sell, that are waiting to be filled. When there's high liquidity, it means there are plenty of traders actively participating, which helps facilitate smoother price movements. This is important because it allows for more efficient trading and reduces the chances of sudden, unpredictable swings. Now, focusing on the fundamentals of liquidity, the key idea is that the more orders there are in the market, the more stable and predictable the price movements tend to be. Think of it like a busy marketplace. When many buyers and sellers are engaged, transactions happen smoothly and prices adjust gradually. Conversely, in a market with low liquidity, even small trades can cause big swings, making it riskier for traders. Understanding liquidity helps us see why certain times of the day or specific currency pairs might be more favorable for trading, because the level of available orders directly impacts how the market moves and how easily we can execute our trades. This concept ties back to the overall theme of market dynamics and trading strategies, highlighting why liquidity is a fundamental factor to consider. Let's take a closer look at buy-side liquidity concepts. When we talk about liquidity from the buy-side perspective, we're really focusing on how investment firms and asset managers ensure they have enough access to cash and assets to execute their strategies effectively. This involves understanding the different sources of liquidity they rely on, such as marketable securities or available credit lines. It's also important to recognize that liquidity isn't just about having cash on hand. It's about being able to buy or sell assets without causing significant price movements or incurring large costs. This is crucial because it impacts the ability to respond swiftly to market opportunities or manage risks. Throughout this presentation, we're emphasizing how these liquidity concepts are central to effective asset management. They help ensure that portfolios are managed efficiently, risks are mitigated, and the overall investment process remains smooth. So, understanding these core ideas is key to grasping the broader picture of market functioning and investment strategies. Let's take a closer look at understanding key locations and components in the market. When we talk about buy-side liquidity, it's often found above certain technical levels like equal highs, resistance levels, and trendline highs. These are areas where a lot of buy-stop orders tend to cluster. Think of buy-stop orders as traders waiting for the price to reach a certain level before entering long positions. At the same time, these levels also include the stop losses of traders who are in short positions. When these stop losses are triggered, they add to the overall liquidity in the market. This liquidity above these levels is crucial because it creates potential areas where the market might react or reverse. It's like a pool of buy orders waiting to be filled, and understanding where this liquidity is helps us anticipate market moves. By recognizing these key locations, we can better understand the market structure and anticipate where price might head next, especially in relation to the overall theme of liquidity-driven moves. Understanding the dynamics of stop losses is crucial in grasping how the market moves. In this scenario, when the market forms equal highs, it often indicates a key resistance level. Retail traders tend to sell at these points, expecting a reversal or a bounce back. They typically place their stop losses just above these highs to protect their positions. This creates a significant amount of buy-side liquidity. In other words, the market has to clear these stop losses to continue higher. This liquidity acts like fuel for the next move, often triggering a sharp move once these stops are hit. So, recognizing this pattern helps us understand why the market sometimes makes quick, sharp moves after testing resistance levels. It's all about how traders' stop orders contribute to the broader market dynamics. Let's take a closer look at sell-side liquidity concepts. When we talk about sell-side liquidity, we're essentially discussing the ability of market participants to sell assets quickly without causing a significant impact on the price. It's a crucial part of market functioning because it ensures that there's always enough depth in the market for sellers to find a buyer at a fair price. One key point to understand is that liquidity on the sell side depends heavily on the presence of active market makers and participants willing to buy at various price levels. This creates a kind of cushion, helping to stabilize prices even during times of volatility. It's also important to note that sell-side liquidity can be affected by factors like market conditions, the size of the order, and the overall sentiment among traders. When liquidity is high, big sell orders tend to be absorbed more smoothly, minimizing price disruption. Conversely, low sell-side liquidity can lead to sharper price drops if large sell orders hit the market suddenly. Connecting this to our overall theme, understanding sell-side liquidity is vital because it influences market stability, trading strategies, and risk management. Recognizing how liquidity varies helps us make more informed decisions and better anticipate market movements. Let's take a closer look at understanding sell-side liquidity, its locations, and its components. Sell-side liquidity is mainly found below key support levels, such as equal lows and trendline lows. These are areas where traders placing buy orders or setting stop losses tend to cluster. Specifically, you'll find sell stop orders and stop losses from buy traders gathering in these zones. Recognizing these areas is crucial because they often serve as magnets for price to move downward, triggering those stop losses and creating liquidity for sellers. By understanding where this liquidity lies, we can better anticipate potential market moves and identify opportunities to align our trades accordingly. This is an essential part of building a comprehensive picture of market behavior and the forces at play behind price movements. Understanding the dynamics behind price drops is crucial in grasping how markets move. When the market forms equal lows, it often signals a potential support level. Retail traders tend to see these lows as a buying opportunity and will place buy orders there. However, they also typically set stop-loss orders just below these lows to protect themselves if the market turns against them. This creates an interesting situation. When enough buy orders are clustered around this support, it can lead to a sudden and sharp price drop. Why? Because once the stop-loss levels are hit, it triggers a wave of sell orders, amplifying the downward movement rapidly. Now, let's connect this to sell-side liquidity. These stop-loss orders and buy stops form a pool of liquidity that the market can target. Traders on the sell side, or those who are looking to push the price lower, often see this liquidity as an opportunity. They might intentionally drive the price down to liquefy these stops, causing the price to drop quickly and efficiently. This all ties back to the overall theme of understanding market behavior, recognizing where liquidity resides and how it influences price action. It helps us anticipate potential sharp moves and better navigate the market dynamics. Understanding smart money targeting strategies is crucial for grasping how the big players operate in the markets. Now, on this slide, we're focusing on liquidity pools. A liquidity pool is essentially an area where many stop losses tend to cluster together. These clusters often occur at key levels like equal highs or lows. Smart money, which refers to institutional traders and professional investors, deliberately targets these pools. Why? Because by doing so, they can maximize their trading advantage. They can move the market in their favor by triggering those stop losses, which often causes a sharp move in price. Recognizing these liquidity pools helps us understand where the smart money might be aiming to execute their trades. It's a powerful concept that ties into the overall theme of understanding market manipulation and smart money strategies. Now, let's look at some key concepts in trading, starting with the change of character, or CHoCH. A CHoCH indicates a shift in market sentiment. When we see this happen, it often signals that a potential reversal might be on the horizon. This can be a valuable clue for traders looking for new opportunities, as it shows us that the current trend might be losing momentum. Next, we have the break of structure, or BOS. This is a more significant event. It signifies a notable change in the market direction. When a BOS occurs, it often suggests that a trend is reversing. You'll usually see this after a liquidity sweep, which we'll talk about shortly. Recognizing a BOS can help traders confirm that a new trend is beginning. Speaking of liquidity sweeps, these happen when price moves toward a liquidity pool, those areas where stop losses are clustered. When this happens, it often triggers those stops, effectively clearing the way for large institutions to enter their positions. This movement is crucial because it shows us where the market is gathering liquidity before a big move. Understanding these concepts, liquidity, structure, CHoCH, and BOS, helps us see the bigger picture. They're interconnected and essential for reading market shifts accurately. By mastering these ideas, we gain better insight into market behavior and can improve our trading decisions. Now, let's look at the advanced trade model in this bearish scenario. What happens here is that buy-side liquidity gets taken, meaning the market absorbs the buy orders at a certain level. This often results in a market reversal from the premium zone, which is essentially the higher price area where traders might have been expecting continued upward movement. When liquidity is absorbed in this way, it signals that the buying pressure has been exhausted, and the market is likely to turn downward. Understanding this helps us recognize potential turning points and manage our trades more effectively, especially when the overall trend shifts from bullish to bearish. This concept ties into the broader theme of how liquidity dynamics can lead to reversals and opportunities for strategic entries or exits.